Hey guys, how you doing?
Good.
So we got Graham and Chris here. Excited to have you guys on the show, and as we'll be getting into it. But I was out, and I was just telling you guys that I was out on LinkedIn doing some rabbit trail, searching for people and podcasts, and came across your guys' profile, and then went into the website, and I was like, oh my god, this is the most interesting thing I've seen in quite a while, because I've actually, ironically, a lot of the handful of the last podcasts have been about just the constant inefficiency of the privately held market and compared to the public market. And Nth Round, you guys are doing some pretty cool stuff. So the listeners might not be familiar with you, which we'll be getting, or the company, which we'll be getting into. But why don't you guys just kind of give a little bit of each of you guys' backgrounds and then how you got to where you are today?
Yeah, so I'll start. I've been in software and finance my entire life. Started out working for a startup in the suburbs of Philadelphia here for first couple of years out of college, and then moved over to an investment manager in public equities here in Philadelphia. But one thing that I learned after joining the startup was that I'm getting these options, and they ended up being worth basically nothing. So I gave them up, but that made me realize that that's actually a common problem, and many experienced developers or people in the startup community end up getting options, don't know what they're worth, and unless a miracle happens, they're probably not going to be worth anything. So that was one lesson that I'd say led to what we're doing now. So I'll let Chris do his background.
Yeah, so I'm long in the tooth for sure. I've been started a few companies, and I'm joining Graham in this one, which is really, really amazing. I've had equity issues throughout my entire career, starting with stock option plans that never became anything, to desperately wanting all of our employees to own shares and fighting with our board on that, and prevailing actually, and all of our employees actually got a fair amount of money because we ended up taking that company public. But still have seen lots of issues with private shareholders, liquidity problems, owners of companies who struggle trying to figure out how to get to an exit. I've seen partners who get into almost fistfights because they can't resolve their issues between each other. So I've seen a lot of stuff with equity. And, when Graham started saying, hey, could blockchain help this? I was like, seriously? And, then one thing led to another, and Nth Round was born. And it is the most sort of miraculous, I would call it technology, software, to solve just about every problem that I've encountered when it comes to equity and liquidity.
Well, and what's interesting too, and just if you can kind of shed a little bit of light to Chris, as you had said, your office and kind of the private equity exposure that you had. So not only did you go through some of this, but I think it was some interesting light that you shed on what you were seeing. I mean, because most of my clients or the listeners, they don't get the opportunity to be bellied up right next to a private equity firm to learn, but not have to actually be partnered with them.
Yeah. So I shared space with a private equity firm, middle market, and I saw how they operate. I saw the funnel and the deals that would flow through, and the EBITDA expectations that were way too high. The thing that I think really struck me was their need for control. I mean, they were unabashed about saying, we are only doing deals if we have complete control. And yeah, we'd like you to keep some skin in the game, but the board, we're having at least one, if not two seats on your board, and we're going to make the decisions, and we're running this company. So let's go. And it was, as I told you before we got on the show, I mean, there was always a fist pump, or a clenched fist. It was either a clenched fist from doing a deal that they thought, they were laughing because they got such a good price, or a fist pump because they were furious that some founder or something wouldn't understand where they were coming from and was negotiating for gotten some leverage on them or whatever. Anyway, it's not exactly the kind and gentle world that many people might think it could or should be.
That's a good way to put it. I actually just interviewed this gentleman. His name was Brent. He actually wrote a book called The Messy Marketplace. He's like, it's all messy. We're all human, and it's just super, super messy. Well, and so I'm curious, Graham, if you want to just maybe give a description of Nth Round, and maybe then we can kind of tie it, because I know, I guess for the listeners and even for my own curiosity, we're saving a lot of my own curiosity questions for the show is, the problems that you're also solving, because of you guys' backgrounds, there's a lot of the bigger overarching problems that I think we can talk about, but then specifically how, I think your guys' platform's fixing or trying to fix some of that stuff. So take that, I guess, however you want to kind of start, maybe with the technology and what you're doing.
Yeah. So as Chris mentioned, we're a software company and we're going after a problem that is definitely messy. It's a problem that is normally solved by broker dealers and through basically smoke-filled rooms, trying to make these private transactions go through, whether it be an employee that has a big chunk of equity that wants to get some liquidity, or whether it's a company sale or an acquisition. These are usually problems that basically are done through very involved processes involving expensive lawyers and bankers. So what we're trying to do is simplify all of that with the technology that brings together companies that are either looking for funding or searching for liquidity, and then investors that are looking for direct access to deals. So our platform, and with the clients that we have so far, they each have their own distinct marketplace where they have digital shares represented as tokens on a blockchain, Ethereum blockchain. But that really it enables them to, whenever they want, without bothering the CFO, post their shares, post a bid or an ask for shares, and put that out without having to deal with all the restrictions and right of first refusal, all of the normal complications that go along with shares. So we tied blockchain technology with a legal construct that's actually from the 1800s, originally used by J.P. Morgan, called a voting trust, and so we married those two concepts together to one, remove some of those restrictions on the stock. So and the way that the voting trust does that is it asks that the voting trust holders relinquish their vote, and that simplifies governance and does a couple of other really nice things, like getting us out of the Investment Company Act. But and then that really enables them enables us to create this online platform which facilitates transfers. Which again, the way it works today is so expensive. Broker dealers normally charge 5 to 10%, and you run into the kinds of issues, messy issues we were just talking about. So we're really just trying to simplify that whole world, which continues to become a bigger and bigger problem with companies not wanting to go public, and the VC world just continues to get bigger. I was
just even talking about how, there was an article I read recently in the Wall Street Journal about how, literally, all these shitty companies are just getting dumped on the public's lap because all the money's been made before. Uber's not even making any money, and now it's public. So, so for some of the people that, we can kind of peel apart some of that stuff, Graham, that you're talking, because I think it is an unbelievably interesting concept. And, when I look at, and actually just recently I interviewed the CEO of Axial.net. I don't know if you're familiar with them at all. It's an online marketplace where they're kind of pinning are marrying up people. But you have the world out there of public companies, right? Where there's analysts, there's a normal market efficiency, right? And then you've also got, in real estate, there's Zillow, right? So it's becoming a little bit more fluid to do this stuff. But, in the privately held sector of all these companies, there are about 6 million privately held companies out there. There is no standardization really even on business valuations. So there's the discounted cash flow, but then there's this company specific risk that I've had a couple of people on my show where no one's really identifying that. So I think I'm curious on how are you handling that? And then we can kind of layer on how the fluidity of this happens, but identifying and getting to the point of this is what the company's worth, because it's so different if a private equity or strategic buyer pays a premium because of other strategic synergies versus internal cash flow being able to pay for itself, the internal rate of return. How are you guys handling that?
Yeah, that's a great question. And definitely it's true that there's a wide range of valuations. Even if you look at 409A valuations versus what VCs are putting, what value VCs are putting in companies. And like you said, once they reach the public markets, the public realizes that, hey, this wasn't actually worth as much as the VCs were saying. So to us, or to me personally, I think the true valuation really comes out once you have buyers and sellers interacting and settling on that price. We think that 409A valuations are kind of BS because on one hand, a company is saying we're worth almost nothing because we want to put a low basis on our options. Mm-hmm. And then on the other hand, to VCs, they're pumping up the price as much as possible. Mm-hmm. So for our companies, we encourage them. Of course, they're private companies, so really it's entirely up to them what information they want to disclose. But we encourage people to release financials and balance statement and P&L, and kind of leave it up to their investors, their shareholders to decide on a price. And
privately, of course, within their walled garden.
Right,
not to the public necessarily.
Yeah.
So then you're saying which is interesting. So is it like, let's say, before you maybe even answer this, maybe kind of give an explanation of who this is for, because I think you did it before we hit the record button. So like, who is the target market of the platform?
Yeah. So we have a couple of different verticals. One is family businesses. Those are, especially if they're multi-generational, those are perfect examples because there's one share class that makes things very easy. Everyone can interact in one place, but also because this actually causes liquidity in general, causes issues for family businesses because there's disagreement about when to sell the company and what direction it's being taken. So that's one area. Another would be startups, whether they're raising new funding or whether they've gotten to a point where they have some long in the tooth investors. So, and when it comes to startups, when you're raising money and you can tell an investor, I don't need to have an exit strategy because we're going to have this platform sitting alongside the company. So whenever you feel the need for liquidity, go there and post your shares. That brings a lot of comfort to investors. And then the third, I guess, would be, similar, but existing businesses, maybe with lots of shareholders, that they want a place to transact into. They want liquidity. Is the easiest way to say it. They have, maybe it's even the founder or employees that have been there long enough and deserve. Maybe they have a kid going off to college. They in our opinion, deserve some liquidity. So those are the three different areas.
I was a couple of months ago. I was having breakfast actually, and our waitress overheard me talking about Nth Round and the liquidity platform and the walled garden. And she stops me after I paid the bill. Like, my friend left, and she goes, "Did I hear you correctly? It sounds like you're almost NASDAQ for a private company." And I said, "Well, that's not exactly right, but we do host a liquidity platform where shareholders of a private company can freely buy and sell the shares amongst each other. It's a walled garden, so it's protected." She goes, "Oh my God, my daughter's starting a restaurant. She wants her cook and she wants the staff to all be shareholders. She doesn't know what to do. Can she call you? I said, "Of course, I'd be happy to talk to her. It's not very expensive. We can do this easily for her. And it will give her the flexibility to share equity and the comfort of knowing that the governance is completely hers. She votes all the shares, but shares the economic interest of her new restaurant."
So, okay, which I think, conceptually, I doubt anybody that's listening is arguing with how needed this is. So then it kind of comes into because I just think about every single one of my clients or anybody I've ever worked with or even been in my CEO peer groups, that this is the problem, right? And so then, one of the questions that I would have is how would, when you said that it's up to them on how much, whether you suggest that they put financials or balance sheet or what, so what is the process of doing this, and what is mandatory, not mandatory? How is it being regulated? Agreed upon? Because I think, the asymmetrical information could be a potential problem, right? The owner says this, the owner values it at this. And then realistically, when you say, because in the normal situation, it goes to market and sophisticated buyers say, no, your company's not worth shit because look at all of these reasons, right? Which is what happens a lot versus, an internal manager. This might be a good way of just believe me saying it, is the managers have this emotional, I want it, but then they don't realize that there is no value there. So there's a chance of potentially having that asymmetrical information issue. So what's the process to going through, and how do you guys handle that stuff?
Yeah. So one thing that we realized very early on was that there's actually a regulatory requirement here that buyers and sellers have access to the same information, that there's an equal playing field. So that is a big component of our platform, is this investor relations piece where companies can post information about their mission, their bios, and like I said, the financials. So, and that really does create an equal playing field. So as soon as someone's invited, even if they're coming in as a new buyer, providing some of the liquidity and buying from a current shareholder, they instantly get access to the full history of information that came out of the company.
It's almost like a virtual data room, like one of the deal rooms, like one of the investment bankers use.
Yeah. And there's not a whole lot to that, actually. It's we host data for them.
Right. It's just
the important piece is the privacy. Companies, like private companies, want to keep their information private. So we spend a lot of time thinking about privacy and the invitation process, and how do we put as much control into the owner's hands as possible. And then once someone's in, how do we then educate the user? And we've actually done some interesting projects with a company here in Philadelphia called Biz Equity that specializes in valuation. But how do we give the shareholders then the tools they need to come up with a price?
Do you guys are working with Biz Equity?
Yeah, well, they may become a client here, but yeah, we haven't officially released anything with them, but we're definitely talking to them.
Oh, yeah, I don't know if it was ever on the podcast, but I ended up talking to a couple of the guys over there. They were part of some of our offering, and and again, I love what they're trying to do too, of trying to get the valuation somewhat out there, and that's where I think, as I've ran their system and their stuff across everybody else, that's where the whole valuation thing is still just like everybody's got such a different approach on how the valuation works. Like, and this is where Ken Sangenario, he owns a company called the Value Opportunity Profile. And he's got a system in it where he just talks about everything comes down to the discounted cash flow for an intrinsic value versus a strategic value. And I just so what is the process of saying, okay, like if I wanted, I got so many clients, whether it's a family business transition, or there's a friend of mine who it's a software company. They have 6 to 9 shareholders, different classes, different percentages. How does it go in there? Like, explain the process of like the valuation towards putting the governance in place for this stuff. And then how does that work? And would every single one of the shareholders or potential shareholders have to have their own attorneys? And how does the whole process work?
Yeah. So this is quite different than an M&A, private equity kind of deal. And those are typically, you mentioned data rooms. I mean, those things tend to be pretty big with lots and lots of data. Because we're a platform, a market, in effect, a software market, mm-hmm. There are bids and asks that you can see the depth of the market. In fact, for our own company, actually, we obviously are our own customer. And we have one shareholder who she's a dear friend of mine and wants to buy a ski condo. She's in her mid-60s, and she's like, would it be okay if I sold some of my shares? And I said, of course. So she gets on, and I coached her a little bit. I said, look, Jennifer, don't put up one, ask and one price. Why don't you spread it a little bit? Why don't you break it into smaller pieces at different prices and just see where the market takes it? Just see what kind of appetite there was. And sure enough, her low ask got snapped up quite quickly, and her high asks are still sitting there today. So, when you have an open market, not open, it's a walled garden, but when it's transparent to the participants, right, who are inside the walled garden, they get to explore where pricing makes sense, and they get to look at the history of where pricing, made sense before. That's very different than a mm-hmm. typical private equity sort of I'm going to break your arm transaction.
Mm-hmm. That absolutely makes sense. I just think, so how, if someone's getting onboarded onto this, is it pretty much just in the hands of the owner of like, hey, this is the overall price that I want to get it? And I'm curious on how you actually do the liquidity, how actually the funds are flowing, and if there's banks helping finance it. But is that making sense? Because I go back to the asymmetrical information, so yeah, you throw the deal room in there, and so it's the financials. I guess in the context of some of my question, guys, is most privately held businesses run their financials like crap. You know what I mean? Or it's not up to GAAP. There's a lot, and this is where the private equity firms take advantage of them, because there's true value there, but it hasn't been maybe institutionalized. to the point where you can actually see that transparency, Chris? So I don't know how are you getting people to be on a level playing field from understanding what the price should be?
So right now we actually just post PDFs, so we don't have a standardization the way that you're talking about it. Definitely, we're exploring that, and that's a lot of what Biz Equity does. Is they have standard fields that every company is required to fill out and say, okay, now we can put you all on the same level playing field. So yeah, I mean, right now we're still going through a bit of a learning process as to how do we do that without then creating some way of gaming the system,
right?
Because that's the other issue that you then run into is if someone figures out that, hey, if we can bump this number up really high, then our valuator or the valuation engine will come up with a very high number for my company. So it's a balance that we definitely have to walk between standardization and not allowing people to game it.
Well,
I think there's something to be learned from the public markets here, though, too. I mean, when a typical retail investor goes onto Yahoo Finance and decides that they want to buy Tesla or whatever, they don't spend a lot of time poring over the financial statements. Typically, what they do is they look at the chart and they go, wow, it looks kind of cheap right now. I think I'll buy some, right? Or, gosh, this looks pretty expensive. I think I'll hold off. And that's much more of the way our system operates. So it's much more like that experience. And I know that private equity guys don't think this way at all, that they want to take a tour of the factory. They want to interview customers. They want to do stuff that you don't want them to get anywhere near. But they're desperately trying to figure out ways to make. And by the way, as you know, it's very competitive among PE firms. So they're also trying to do this slyly so that other PE firms don't hear about it and get in the mix. I just think this is a very different environment. And, we're not talking about selling the company lock, stock, and barrel. We're talking about one shareholder buying from another shareholder, or the owner of the company deciding to invite in a new person that they think would be great as an additional participant who wants to invest in the company. And you invite that person in, the owner invites that person in and now can see the book of ask orders and act on them, or the book of bid orders, or he can put in his own bid, whatever. I mean, it's just a really different approach to how to buy shares of a private company as opposed to buying the private company lock, stock, and barrel.
Well, what's interesting, guys, is a lot of the problems with business valuations, which is what, by the way, Biz Equity doesn't do. So I would argue that the one thing that they don't do well is identifying company-specific risk. So which they just have the safe harbor of 2 to 8%, which is total garbage because you don't know whether two companies, A or B, have an ERP system or don't. They've got the same financials, but the company-specific risk could be wildly different. However, in your situation, just the general environment of it is the employees actually know the company specific risk more than anybody else, right? So they just intuitively, to your point, Chris, that'll be factored in the pricing, actually.
Exactly. This is about voting, right? This is about a bunch of people voting on the valuation, not some analyst sitting in a room trying to justify it. And I was just going to, as you were talking there, I mean, the difference in valuation can change dramatically based on whether a person decides to stay or leave after the company is sold. I mean, that could cut the valuation in half or worse if it's a key person.
I know, and it doesn't, and none of that stuff gets factored in the business valuations, which is just ridiculous. How are you guys dealing? How is the actual liquidity happening? So how are funds flowing, and what is the actual mechanisms behind the scenes?
So there are two ways to do it, and a lot of it depends on how much monetary value we're talking about. So the first way, if you really like US dollars, you can do a direct transfer to another participant, and then basically have them wire the funds to you. We're not in love with that because, and this goes back to something we were just talking about with employees being owners. They should actually, we think the participants should all be anonymous or pseudonymous, I guess is the correct term for it. You don't want other participants saying, oh, I know who this person is, and I know that they're selling at this price, and they must know better than others. We'd rather have everyone be just an account number trading. So, but then the other way to do it, which we like a lot better, is going through and using the full power of the blockchain, which is to send the funds in the currency of the blockchain that we're on, which is Ether. So you put up your bids, or you put up your bids with real Ether, and then the tokens and the Ether are transacted at the exact same time. That gets us out of all kinds of things like being a transfer agent and exchanging important or private information amongst participants. Whereas now it can all be done on the blockchain, and we have a price associated with it that doesn't need to be brought in from an outside source.
Yeah, I think it's important to recognize that we're not a fund, right? We're not a source of funds. In fact, we're not a broker-dealer. So we can't even hold ourselves out as being able to find, buyers for you. It's not what our business is. We're a software company. We do have friends, and we certainly can, make casual introductions. So it's a little bit up to the company. Maybe they want to reshuffle the deck a little bit between shareholders. If there are more sellers than buyers, then it's definitely up to the company to be able to, bring liquidity sources of capital to the walled garden to be able to buy the shares from those who want to sell. So again, we're a software company that has figured out a way to provide, a compliant and transparent platform to allow buying and selling to happen in a very comfortable, transparent, regulatory compliant manner.
So then is there, if let's say I own the company, I got, 7 other owners, and we wanted to reshuffle the deck. I'm literally working with the client right now, and this is where an ESOP or a non-leveraged ESOP or some sort of partnership. You're talking spread. Trust me, I literally just went through a use case of what this would have potentially worked, where the shuffling and how much work that takes, and how do the funds flow and all that stuff. So in that case, a lot of the challenges with family businesses and or management buyouts is the managers or family don't have the money to provide the liquidity, right? So in the ESOP world, they become a non-taxable entity, right? So that entity can take out a loan and pay it back pre-tax. So there's enough cash flow to self-sustain the debt repayments. I'm just curious on do you have banks that you actually are being progressive in this stuff that are providing the people that don't have money to come in and be able to provide the liquidity? Or is it the business entity itself that's taking out the loan and paying these people? I'm just curious on actually when you bring in the capital, how would that actually work?
We haven't done a restructure quite like that yet that requires borrowing money. I definitely foresee that happening because we hear about that a lot. But yeah, so we're happy to work with other banks to facilitate that. But we haven't run into it. Maybe it's because we're talking about more bite-sized chunks of equity rather than like Chris said, selling a big chunk of the company. And even if we do have, in the example where we do have founders selling off some of their ownership, they still do it in smaller increments than let's say putting up. And we actually encourage them to do that, because that's another piece of finding the right price is break it down into smaller chunks.
Do it over time versus and doing it over time versus, because I think about maybe it has to do with some of the companies that I'm working with. They're looking for 1 to 4 or 5 years out, and it might be a $2 to $30 million valuation. So it's a little bit more the middle market, lower middle market, where they want to kind of maybe divest of a bigger chunk here and there, and that's where the manager might be making 100, 200 grand, but hasn't saved up enough money to be able to wire them 500 grand to $1 million. And that's where the contract for deeds or, the promissory notes come in. It's more how do you actually structure the financing to make that work? Yeah.
And that goes back to the fact that, this is so much different from the current world, because usually when you hire a team to work on a transaction like that, it's one and done. You don't want to go through it all again. But with this, it's permanently in place. So you can play around and get, in 10 minutes, go through a transaction and say, okay, that was cool. Let's try it again at this price and at this quantity. So you can do a lot more. There's just so much more flexibility that you have.
Yeah. Yeah. I mean, our system would cost a fraction, an order of magnitude less than the cost of one typical private equity transaction.
Mm-hmm.
I'm not kidding you. So, we're, depending on the size of your company, anywhere from $4,000 to $12,000 a year to host the whole system. Mm-hmm. And once it's in place, people can use it. We don't charge any fees, right? There's no brokerage fees, none of that. So people can, use it in any way they desire. And again, it's such a great way to get some liquidity for those who need it. And the truth is that most of our clients, when we say, hey, do you need someone? Because we have people who ask us this all the time, can we invest in some of your companies? So we ask the question, are you looking for new investors? And every single one of them says, no, we've got plenty of demand. You don't have to worry about the demand side.
So what is the typical adoption rate of employees? I'm just curious, in that, and then what percentage of the company are people kind of chunking out? I mean, is there recommended, what do you guys see? What is typical?
I mean, employees love it. I would say as a group, employees love this more than anyone else, because it's something that just has never been available to them before. And actually creates a lot of transparency for them, so they can get an idea of how much are their options worth. And a lot of times founders hear that and they think, oh no, well then how am I going to retain employees? But it actually, with this system, you can put as many restrictions in place as you want to. Let's say employees fully vested, but you only want to open them up to 10% of their ownership in liquidity. That can be done very easily. So any of the kinds of restrictions that the owners can still be put into place, and maybe even be done in a more creative way, incentive based, or maybe it's not even an annual vesting schedule. Maybe you want to make it a daily vesting schedule. It's with software, all of this can be done.
The fact is that employees that you give liquidity to you fall so deeply in love with you and become so loyal to you that they're never going anywhere. Mm-hmm. All they want to do now is rave about how much they like working for you and for you. In fact, we stopped doing options. We're just about to have a board meeting to cancel our option plan and replace it with grants, because the visibility to liquidity makes owning the underlying equity worth 10 times more than owning the options, which are these frilly pieces of paper that no one understands and sticks in the bottom drawer because they've heard so many times that they never become worth anything.
Well,
we just recruited some advisors, right? And we kind of asked around, and people said, well, are these really top talent advisors? These are some of the most, well-known names around. And we said, well, how much do you think they're going to need? Typically 1 to either a half or 1% of the company in options is normal. So we thought about that, and Graham said, well, to hell with it. We should be doing what we espouse. Let's grant them shares in the form of tokens on our liquidity platform. So we went to these guys, and Graham said, how would it be if we gave you $10,000 worth of tokens? Well, you'd think that we just handed them, the Philosopher's Stone. I mean, they were so excited and immediately said yes, versus us having to maybe offer them $50,000 or $100,000 worth of options.
And it's real immediate.
Well, I was going to say, technically it'd be, you could almost argue that it is essentially the same value, because, it's almost like the same thing with Phantom stock that I see guys were I know too many stories. If you structure the comp plans the right way, but you think about how much legal fees and how all this stuff that you have to do to set the comp plans up the right way versus just letting it naturally happen. Whereas in the Phantom stock, plenty of stories where it's the golden carrot, where there's no annual cash bonuses or anything like that. So it ends up being this golden carrot that's so far out, and kind of like what you're probably dealing with, Graham, in the startup place, where it's just it's too far and too ambiguous of when and how this will ever happen. And I know people where they're literally freaking miserable in their job, but they won't leave because of that. And it's not good for anybody.
Yeah, exactly. I was just going to mention, since you had asked about adoption, that at the other end of the spectrum, there's employees that love it, but we actually run into some VCs, especially East Coast VCs, that they hear about this and they think, well, heck no, I'm not gonna allow anyone else to get liquidity before I do. So, but that creates all kinds of unintended consequences. We've even met founders that are shopping their company around because they personally need liquidity, And it's not at all what the VCs had intended. But and like I alluded to with the West Coast VCs, we're actually seeing a big difference. NEA backed us, and they love this idea. It provides them a lot of flexibility too. They've got all kinds of companies that they would love some liquidity on, but some of the East Coast companies or VCs, they'll say, I want a big exit. And if it's not a big exit, then the company should die.
Well, I mean, that's the VC world, right? Versus the more the PE world or the people that are more professional. Right. This is very interesting, guys. I'm curious on one is what percentage of the company that people put up on the market? I mean, that you're seeing, is it the whole thing or they chunk it out?
No, especially, we just started mid last year. So we encourage people to start out with a small percentage, and they can always increase that percentage. So 10%,
Yeah. I mean, Jennifer's selling, she started at $30,000 worth, and because the price went up, it's now, over $50,000 worth. And you can imagine how happy she is.
That's awesome.
I mean, she's elated right now. She bought 2 ski condos.
That's awesome. That's awesome. And what is the bigger mission that you guys are what are the milestones? I mean, obviously you've got some probably pretty big grand visions as far as what the platform is capable of. But so what are the milestones that you guys are marching towards? What are the big, what would you deem a success?
Yeah. So by the end of this year, we'd love to have at least 50 clients on the platform. And we know that we're targeting just one side of a two-sided marketplace. So yes, we're going after companies initially, but the plan is to then start to create a list of investors that want direct access to deals, and they want a buffet of deals that they could possibly invest in. So the idea is to have 50 or so companies waiting for them when we do decide to bring them in. And then at that point, we can start to become almost, we've called it like an eHarmony of private investments. So companies are looking for a specific kind of investor that maybe likes, their industry and has experience in their industry. They can find them through the platform. And then on the other side, investors can find the companies that are good for them based on their risk profile and things like that. So becoming that matchmaking service, I think, is where the value of this really becomes extraordinary.
And that's where that actually. Oh, sorry. Go ahead, Chris.
I was just going to say, there's also a democratization ideal that we really are anxious. You had mentioned, would you say 6 or 5 million private companies in the
there's
US?
27 million incorporated, and there's 6 million companies with employees.
Yeah, I think 5.5 million have 50 or more employees. On one statistic that I read, and there's only 3,700 public companies today.
Half is what it was 15 years ago.
Exactly. So, that means like for every public company, there's something like 1,500 private companies, right? And this technology could be pervasive. Everybody could have it. It's just not that expensive. I mean, it could be, like buying, a suite from Microsoft practically. And why wouldn't you do this? Why wouldn't you have a liquidity platform that your shareholders have access to and that you have access to, so that you can really dramatically enhance the value of your company? Because I'm sure you're familiar with the famous, illiquidity discount, right? DLOM. And that typically runs anywhere from 25 to 50%.
Yep.
So if you flip that around and you think about the markup that the pop that your company could get in value by availing your shareholders liquidity, you could see anywhere from a 30 to even 100% jump in the value of your company. And that's huge.
Well, it's huge. Well, 100%. And then even to expand on that is that, the one thing that privately held companies don't get is other people giving their insight. You know what I mean? Because you have all the analysts and their advice factored into the price of the public markets versus most owners are just running blind based on what they believe in their gut, which, God forbid, there's not really any other options. So then, I think that also provides, you being able to ask the question, well, why is the value like this? What else do I need to do to increase the value? The biggest challenge that I've seen, guys, is and my dad and I were the same ways. I mean, I've been part of Vistage and all these, CEO peer groups that you may or may not be familiar with, but like everybody only talks about top line. And I'm like, that has to do with value, but very little to do with it. It's all these underlying things that are like significantly important but you don't really understand how to view that stuff. So to your point, Chris, I mean, this is something that points everybody in the right direction of measuring value instead of measuring top line. And the more people that have insight into that, the more you can factor that into your strategy.
We haven't really talked about the investor relations and how useful that is to a company owner. I think that's something that you're value.
Yeah, I mean, that's something that we've spent a lot of time on recently is just the importance of communication between owners and shareholders. We've been experimenting with a bunch of different ways to communicate, and we've actually landed on video. We're really liking video as a format to communicate, and that can have all kinds of positive effects. And when it comes to companies that are seeking a next round of funding or seeking more funding, that can be the difference between getting it and not, because we hear some angels say, I only hear from companies when they want money. And that's not a good feeling for an investor. So having, and it doesn't take very long to just foster a good relationship between shareholders and owners. So that's something that we've written quite a bit about on our website and are trying to promote.
Yeah, it's built into our code.
Yeah.
Yep. Well, and actually, I remember what I was going to say earlier, and you guys kind of talked about it when you're talking about matchmaking. Is I think that there's this huge opportunity. I really do believe, especially as that most of these boomers are going to be transitioning. So, Chris, I have those numbers that we were talking about. It's like 2/3 of them are going to transition somehow in the next 5 to 7 years. I think there's the opportunity to have. Like, so if I think about like the CEO peer groups that I've been in, like, everybody else knows each other's companies or each other and a decent amount about each other. I believe a lot of people would invest in each other's companies. You know what I mean? Exactly. As a way of diversification, going, okay, well, I understand these privately held companies. So it's not just like the big institutions. It's literally just the other CEO peers of yours saying, okay, I believe in you, but right now there's no way of dealing with that and giving you, couple grand here, 20, 30, 100, 200, whatever the price might be. But I think there's a huge opportunity to use the CEO peer groups as a mechanism to do that.
For sure. We have a company in our building here that as soon as they heard us pitch, they said, well, I would love to diversify out of my company and into some of my friends' companies, because he recognizes that private companies are where the highest, the most growth potential is. But he just wants to diversify out of his own company some. So that was really cool.
Yeah.
Cool idea.
And a lot of people talk about how great it would be to own a piece of SpaceX. Well, you know what? That dream could come true pretty soon. If we have our way, you'll be able to buy some SpaceX.
Yeah. I love it. I guess we've covered a lot of ground, guys, but is there, a couple of things that we haven't talked about that you want to bring back up or highlight or I'm sorry, if there's something we've talked about that you want to bring back up and highlight and leave our listeners with, or if there's something we haven't talked about that you want to make sure that you leave everybody with, what would it be?
We kind of just covered the huge opportunity here, and the fact that democratization is the power of democratization is so huge here. The fact that retail investors don't have access to a lot of the highest growth investment opportunities out there. But another thing which I think we only very lightly touched on was compliance, and the fact that the reason why so many people shy away from this is because of compliance and the SEC. But I was just on the phone with Martha Miller at the SEC on Friday, and we met with Commissioner Pierce in the fall. We've had nothing but good experiences with the SEC, and they've more or less blessed what we're doing here as something that could really change the private finance world. We even talked to Commissioner Pierce about the accredited investor limit, and she said, well, that should go away entirely, which we were really surprised to hear. But
because they've now got, what is it, the regulation A and D. I mean, so they're trying. It sounds like they're being pretty progressive.
Yeah, they're trying.
But they would rather have these things happen in the private marketplace. That's why I think they're so excited about us. I mean, Commissioner Pierce was glowing when we were with here, because she thinks that markets are broken. She just sees it and she says, we need people like you who are thinking creatively and can fix our markets in the United States. She was very, very supportive and has been continuously. Well, I think one thing that I would like to make sure the listeners hear is that, with the liquidity platform in place, you have the opportunity to get some liquidity without giving up any control. In fact, while consolidating control. So anybody who buys your shares, you're going to continue to vote those shares.
Can you explain a little bit more about how that works?
Yeah, sure. So as Graham mentioned, we use a voting trust as the construct for this. It's an exemption from the 40 Act. Most people are familiar with 3C1 and 3C7. This is 3C12. And so any voting trust is exempt from the 40 Act. And regardless of the number of participants and the kind of participants, there's nothing about accredited investor. There's nothing about a 500 or 2,000, limitation on the number of shareholders. But the voting trust, by its definition, says that the participants relinquish their vote to the trustee. And the trustee is going to be you, the owner of the company. So as soon as anybody enters the walled garden, one way or another, they're going to relinquish their vote to you, which puts you in complete control and simplifies governance, and yet allows you to share the economic benefits of being an owner of your company.
That's pretty cool because what most people don't understand or very vaguely understand is that when they give even 1% to someone else, they have a fiduciary and prudent responsibility of disclosing ridiculous amounts of information and control and all this stuff that they just, the hair that comes with just one share of equity at this point. And I don't know if that changes a little bit or if because the trust is the gatekeeper of this, does that impact how that works?
So what we look at is a regulation called 4A1.5 that governs the transfer of private securities between two parties. And in that statute, there is a requirement that the buyer have access to reasonable information about the company. It can be in a private setting, right? This doesn't mean that the company has to disclose it to the world. It's just that the buyers, the participants, need to have access to reason. And they don't even specify what that needs to be. So the company really can decide what it is. But again, we think that, in this day and age of open source software, it's just the right thing to do to share reasonable financial information. I mean, why not?
Yep.
And so that's really that's the guiding light behind what we're doing is this regulation 4A1.5.
Well, I think it's, just going back to where you're saying, like the big picture of what you guys are trying to do, and the public markets are broken. I think people inherently know that, but they just don't know why or how. But unless you get into the world like we are, where you're digging in the weeds and you just realize that the people that are making the money are the people at the top shuffling the money around. But there has to be economic value and profits that fund everything, which is essentially the backbone of America, which is all the companies you're talking about, right? There's less financial engineering, and it's really just gross profit coming in from products and services that are sold.
Yeah, I think the one thing that's really cool is that you can lay a liquidity platform, the voting trust, on top of any structure. So you can lay it on top of an LLC, you can lay it on top of an S Corp, you can lay it on top of a C Corp, you can lay it on top of anything you want. It's a trading platform.
It's a very thin layer that it actually, it's the fact that it's called a trust is a bit of a misnomer because it predates trusts and estates, which happened in the 40s.
Interesting.
It's a contractual agreement among shareholders.
Super cool. Well, guys, this has been a lot of fun. What's the best way for the listeners to get in touch with you and to learn more?
nthround.com. You can message us directly. So feel free to reach out.
It's a weird name, right?
Yeah.
People go, is it Ninth Round? What's Nth? So it's like Nth degree, right? And our byline is the power of liquidity, right? Because N is like the power of whatever. And it's like the, A round, B round, so this is the Nth round. So once you do this, you don't need to do it again. So, and we have some of our friends saying, oh, it means I've had so much to drink that I can't even remember what round it is. So I'm just going to call it.
Yeah, you're buying and selling while you're inebriated. Perfect. No, guys, this has been a lot of fun. Very much appreciate coming on the show.
Thank you.
Thank you for having us.
It's really great.
Thanks, Ryan.